Hi, welcome to Barchart's weekly series of webinars to help you, the investor or trader, understand a variety of trading concepts. But more importantly, the tools that Barchart provides to help you with your process. Today's subject, Bull Call Debit Spreads. These are one of the more popular forms of option spreading. Why? Well, because this type of option strategy allows the trader to profit from a bullish sentiment or bullish price movement with a very low capital commitment, not a lot of monies that we're going to put up, and a minimum risk exposure. In other words, because of the power of leverage through options, we can capture the same price appreciation of a stock without actually owning it, and at the same time be protected from a large reversal of price in the stock, or our risk will be limited to the downside. And as Martha Stewart once said, that's a good thing. All right. Okay, before we get started, I just want to remind you all that, hang on, let me get my cursor over here, there it is, that all of our webinars are recorded, and you can find an archive of all these webinars under the Tools page, Free Webinars. And there's all these webinars that we have been doing through most of the summer and fall. So you'll have an opportunity to go there. If you register for this one at some point later today or tomorrow, you will get an email link to this particular webinar. All right. Okay. All right. Well, hello, my name is John Rowland. My goal today is to give you folks some basic understandings of this strategy, the tools that are available to you for your decision-making process, and hopefully to bring some of my personal 30 years of experience to help guide you through this process. I kind of call that my food for thought for you. As always, with me is our moderator, Jean Baker. Hello, Jean.
Hi, John. How are you today?
I'm doing well. How are you?
Doing great over here. Thank you.
Good. So Jean is going to help me watch the chat and help answer any questions that you folks might have, technical questions about, some of the tools that I'm showing you. And I will apologize if I don't get to everybody's questions today. If you feel a need to have a question answered, I would suggest that you would send your question to support@barchart.com, and our crack staff there will help answer those questions. If they need some more clarification or it's something very specific to the webinar that we're talking about today, they will forward that to me as well. I do answer all my questions, but please give me a couple days time to answer those questions, okay? Again, remember that all trading has an implied risk, and that decisions to buy or sell or hold a trade, a security or commodity or any other investment involves risk, and that it's important for you to understand those risks and seek the advice of a qualified financial professional. And that today's webinar is for educational purposes only and should not be construed as an endorsement to purchase or sell any asset. And all examples that I'm going to show you today are for illustrative and demonstrative purposes. In other words, what worked in the past not necessarily will work in the future, okay? So just be aware of that, okay? So what is a bull call debit spread? Well, a bull call debit spread is referred to as a vertical spread and directional spread, where a trader is simultaneously going to buy a strike, a lower strike, and sell a higher strike price with the same expiration date. Since the lower strike is always going to have a higher cost than the higher strike, this will require a capital outlay. In other words, what we would call a debit, all right? The strategy itself is similar to other bull strategies, for instance, just buying calls outright, but the profit is going to be limited or capped by that higher strike call. What's nice, though, is that the premium collected from that higher strike call is going to help offset our capital outlay. So here's an example of that. This is Apple. And so let's do some look at this chart here. We can see that on this particular day, Apple is trading around $95. Now think about this. If I was going to buy 100 shares of Apple at $95 a share, my capital outlay would be $9,500. That would be a lot of money for some people who want to trade Apple, or if they thought Apple price was going to go up, right? But what we're going to see here is that when we use this strategy, we don't have to put up as much monies to take control of that price movement, so to speak. So here we see a lower strike price of $100. That's going to be our long. We're going to purchase that. And I'm going to just make some assumptions here. I don't know for a fact what it was trading on that day, but let's pretend that it's going to cost me $5. Remember that when we look at pricing of options, they're in a per share price, but each option represents 100 shares. So if I have a $5 per share value and I buy one option, $100 strike, my cost will be $500, $5 times 100 shares. But let's just concentrate on the per share value. So it cost me $5 to purchase it. My higher strike here is a 115 strike. That's the one that I'm going to sell or create what we call a short. I know I'm not paying for that. I'm going to collect. I'm going to take in premium. So I'm going to get a credit in this case of $2. So what would be my net cost, my total cost? Well, it would be the $5 that I lay out to buy the 100 strike and the $2 that I'm going to collect to sell the 115 strike. So my net cost would be $3. What does this mean to me? Well, if I look at that value, $3, now I can do an assessment that's called break even. How much does price have to go up above my lower strike before I start to make money? If price is at or above $1.03, 100 plus the $3 of my cost, then I will break even at expiration. Or if price is above 103, I will start to make a profit at or above 103 at or at expiration. Okay, so what are some of the advantages of a bull call spread? Well, profit can be achieved with a price appreciation of our stock without that capital outlay, without putting up that $9,500. Here we see that in this case, we would only have to put up $3 times our 100 shares, or $300. And we don't have that risk to the downside of our stock going down. If I bought Apple at $95 and Apple went down to $75, I would lose $20 per share. But in the option, we're only risk is our capital outlay. Our maximum profit is, again, limited by that higher strike price. So in theory, what would happen is if, let's say, price rallied to the higher strike at or above it at time of expiration, what we would do as a trader would do is exercise our $100 call, and we could be assigned, or the person that bought the 115 call would exercise their right, and then we would collect the difference between the 100 and the 115 strikes. That would be our profit, but that's not our net profit. We still have to take in consideration the $3 that we outlaid. So our maximum profit is the difference between our strikes, but minus the cost that I'm going to put into this trade. So in this example here, yes, we would see a price appreciation of over $15, but we're only going to capture $12 $12 of it because it costs us $3. Now, this is where there's a difference between, let's say, just buying calls outright or buying the stock outright. Here, you could continue to profit, but we're going to have our profit capped. We're not going to be able to get any more profit once price gets above our 115 strike. Okay. What are some of the risks that we need to be aware of in a bull call spread? Well, the first risk is our maximum loss. And again, it's limited. In the worst case scenario, what could happen is, let's say the stock price does not go up, it actually goes down, and the stock now is below our lower strike at expiration, then both the calls would expire worthless, and we would only lose the net results of buying the one call and selling the other. Again, break even is achieved when at or above, at expiration, we're above that initial price, that initial strike, and our investment. And there is another risk that you need to be aware of, which is called the expiration risk. And so follow the scenario that's going on here. What happens if our position, right, we held it to expiration, and the asset or the stock price has risen above our lower strike, but has not achieved that higher strike value, right? So what could happen is most of your brokers, once your stock is in the money, once price gets above your strike price, at expiration, they're going to exercise that for you. Now, it's not always guaranteed that they're going to do that, but it's pretty common practice now among all brokers. So that 100 strike, you would be exercised. Now, think about this. You're going to be exercised. You're going to have the right to purchase Apple at $100. Well, $100 per share times 100 shares, that would be a $10,000 capital outlay. You would have to have that capital in your account to allow you to do that. Let's assume you did have that capital outlay. Now you would put up the $10,000, and let's say whatever price Apple is, you could reap that profit. But the risk here is that the expirations that come on our Fridays, you're not going to get those shares into your account until Monday morning, even though you have purchased them on the close of Fridays. So you are going to have risk, price risk, over the weekend if you exercise your call, all right? So here's that example. Let's assume that it's that Friday, it's expiration, and the price of Apple is around 114.07. We're going to make a profit on this trade. We're going to exercise at $100. Our profit is now unrealized because now we own the stock at $100, but the stock is going to close at a value of 114.07 cents. But we're not going to have an opportunity to trade that until Monday morning. We could be at risk if Apple goes down. If Apple drops down $20, then we would be out all of that profit. So it's important for you to understand this concept if the strike, the higher strike, is not achieved, right? And even if we get to the higher strike, there's no guarantee that you're going to get assigned. So our best practice will be to close both positions, both the long and the short. How do we close a long? We sell. We sell out that long call, that $100 call, and we're going to buy back that $115 short. Now, what will happen in here is the bid asks will be a little bit wider, or you might not be able to collect that total profit. In this case, the 103 to 114.07, $11.07. It might be a little bit less than that because we'll have to buy an offer and sell a bid. But if I can capture 90, 95% of that total profit, I still consider that a good trade. All right. Okay, so that's just some kind of the basics for us to understand as we go through the screener. Now, I do see some questions here. And we'll get to Moneyness in a second. How does one close the position spread as individual close leg? So that's a great question. So I would suggest to you, those of us who are interested in trading spreads, option spreads, is make sure that your broker or your platform that you're using allows you to trade as a spread, okay? So yes, we could leg one at a time, but that does create a risk for you. But many options platforms will allow you to put in a spread trade. For instance, in that example I just had there, where we were trying to capture about $11.07, you would put in an order to sell that spread at $11. You're going to give away a few cents to get out of that trade. So I would recommend, if you're going to trade spreads in options, is to trade spreads as spreads. So make sure your platform allows you to buy as a spread and sell as a spread, okay? All right, so here we are in Barchart. Back to our main page, we're on our options, and we're in the Bull Call Debit Spread. I'm going to click on that. And now we'll wait for our results here. I see another question pop: narrow versus wide spreads. So we'll talk about the difference between weeklies and monthlies, but if you stay in monthlies, you're going to find that your spreads will stay a lot narrower even at the time of expiration. But if you're in a weekly options, you will find that those bid-ask will get a lot wider. Matter of fact, it's almost 50% wider, depending on the liquidity of those different options. Okay, so I hope that answers that question. All right, so you can see that our Bull Call Debit Spread screener now has given us up to 1,929 possible outcomes or trades that would be profitable. And again, they rank them in terms of max percentage profit. So you can see that Pfizer here is at the top of the list, where you could potentially, if you took this trade and it came to max position, you would make 855%. So let's look at the columns here and see if we can learn some things. First of all, here's our symbol column. If you don't know what the symbol is or what the company is, you can click on the plus sign, and you'll see the name of the company, and you can scroll to the right here. You get a little chart, some headline news, some opinions, performance, key statistical information, so on and so on, right? So you can go in there very quickly and look at that. The second column is our price. That's the last price of Pfizer. And maximum profit. Again, remember, maximum profit is the difference between our strikes minus our capital outlay. So in this trade, we could have a maximum profit of $11.64. We come over here, we see that our lower strike is $37. Our higher strike is $50. Difference between 37 and 50 is $13, but our cost, our maximum loss, is 136. So 13 minus 136, check my calculator, is $11.64. Okay, maximum profit percentage is just the total profit divided by the total debit, or in this case, the maximum loss. So $11.64 divided by $1.36 would give you a 855% value. So we divide those two and then times it by 100 to give you that percent value. All right. Our max loss, again, is the capital outlay to purchase the long leg and the credit to take in. So again, here is, we're going to buy our lower $37 strike at $1.46, and we're going to sell the $50 strike for 10 cents. So the difference here is $1.36. That is our maximum loss that we would take on this trade. What is my break even? Again, break even is our lower strike price plus our maximum loss or our capital outlay. So $37 plus 136 is break even would be $38.36. If this trade is going to become profitable, not max profitable, but profitable, price of the stock would have to get above $38.36. All right, probability. So probability is a complex formula, and I know that many of our more advanced options traders, I would call them in a very positive note, math geeks. I respect them for that. If we come over here to the help section under the probability calculation, you can see the calculation, how they come to probability. I love math. I believe math is a strong component of trading, but this is definitely above my pay grade as far as understanding the formula, and those of us who understand that formula will, God bless you, and let's kind of just make it simple for us lay folks. So let's think about probability in terms of a seesaw. And on the left hand of our seesaw, we have probability. And on the right hand of our seesaw is our profit. And so what happens is, as probability goes up, our profit goes down. As probability goes down, our profit goes up, right? So we're going to use probability as a comparative analysis. When we get down to the actual stock that we're looking at, and we have different strike combinations or strike differential combinations, we're going to measure that probability versus the profit, or the probability versus the cost, to help us do a little bit more comparative analysis. If anybody's been to a racetrack and you've understand how pari-mutuel betting is done, you think about it at a racetrack. If everybody at the racetrack believes the outcome of one horse is going to win, everybody bets on that horse, those odds on that horse falls down, right? That horse has a greater probability of winning based on the odds, but since everybody bet on it, the odds will be a lot less. If only a couple people bet on a horse, then that horse's odds will be a lot greater. So kind of think of it like that. What is our expiration date? What is our strike, our ask, our strike, and our bid? Okay, all right. So 1,200 or 1,900 is a lot to choose from. Now, one of the things I can do is I can come over here and click on symbol. And what this will do is it will sort all these opportunities, not by the percentage profit, but by the symbol. And you can see that we have American Airlines here, and a lot of these trades are American Airlines. Look how many are Apple. So even though we had 1,900 different choices, it might not be 1,900 different stocks, right? So you could sort it that way. If you knew your stock symbol was at the back of the alphabet, we could flip it around and go from Z to A and not from A to Z, right? Or if you know you want to look at a very particular stock, we can come up here where it says set filters, and we're going to look at this a little bit more in detail. But one of the things I can do is come over here where it says select under my underlying asset. I'm going to select the symbol. I'm going to add it. Right, here's my symbol. I'm going to add it, and I want to match it. I'm going to match it with the stock symbol that I'm going to trade. And so let's pick one that's in the middle of the alphabet, and I'll say Microsoft. And now I'll click on the result, and the screener now will only show us all the different trade opportunities that are for Microsoft. And again, look how many opportunities we have. We have 63 different combinations that we could go through. So there's a way you can filter down to the individual stocks if you know if that's what you want to do, right? Okay. So like all of our screeners, we do have other multiple views that we can use. This is our main view. We do have dividends and earnings. And let's talk about these two, because these two definitely will have a factor on all options, but particularly this strategy. So again, some of the same columns, symbols, price, max profit, but we do have our dividend, how much was paid in the last dividend, and what is our ex-dividend date. So let's talk about dividends. Dividends do have an effect on option prices, because what happens is when a dividend is ex-dividend and the dividend is paid out, normally what we'll see is that the price of the stock, the underlying stock, will drop by the value of the dividend. So a falling stock price will have an effect on call options. It will make those call options a little bit less valuable. Put options would be just the opposite, right? Because falling prices would be good for put options. You might see put options go up. And again, we'll talk about delta in a second, but that relationship between the dividend and delta will give you a kind of a fair value of how much you can anticipate your option to change by. So what's important for you to understand here is if you set up a bull call spread strategy and your expiration is right around the ex-dividend date, there could be a dividend declared that would affect your trade. So that would be something that you would need to be wary of. If we think about earnings is definitely a catalyst for price action. Good earnings can make price goes up. Sometimes good earnings make price go down. But we just know that earnings or earnings announcements is a catalyst for price action. So there are some traders who will look at earnings as an opportunity to do one of these strategies. Those traders are probably going to be using what we call weekly strikes, weekly expirations versus, let's say, monthlies. But you could have an earnings and a monthlies expirations that come very close. And these are probably more speculative, aggressive traders, a little more short-term traders. So again, we might want to embrace earnings, or we might want to avoid earnings. And again, what I can do is I can come under to my set filter, right? And type in the word earnings. And here we see it says expires before earnings. So I can click on that. I'm going to add that. And I do have a couple of options here. I'm going to show only options which expire before earnings. Yes, I want to avoid options. I want to avoid earnings. I don't want that to affect my strategy. And if I did that result, well, let's see what happens. It's probably going to knock it down. Yeah, it knocks it down to 64. So it really will change our results. But let's say I want to embrace earnings, right? I'm going to use earnings as that catalyst. I'm going to say no, right? And the next box here would be exclude options that are without earnings dates. So sometimes companies haven't announced their earnings dates, or the data feeds that we get for our screener hasn't picked that up. It's not a good or a bad thing. It's just something that you need to be aware of. And again, we're going to see a much larger result here, because now we're going to look at all options that encompass all earnings. And again, you can see that. So if you're going to be an earnings trader, then you could use this as a way to filter those out as well, or avoid them. Okay. All right. Let's go back to our results. While I'm waiting for the results to come, I see a couple of questions come up. Marcus asked, if I sold a put option about to expire out of the money with still a premium of $2.10, do I leave it alone with it or let it expire worthless? Well, again, I think if you are $2 away from that strike price and it's on expiration day, what's the probability of that getting there? Probably a very low probability. So you could probably let that expire worthless. What I'm talking about, Marcus, is when we're really close, right? We're really close to it. And if we're even at that higher strike, because we're not sure we're going to get assigned that higher strike. So that's why we want to close up both legs. How does options trader protect themselves from short-term higher strikes going into the money when price of the underlying falls? All right, so maybe we'll get to can do that one. I'm confused. Does a higher probability mean higher profit? No, it's inverse. Higher probability, lower profit. Lower probability, higher profit. And think about it. What we're really doing is it could be the differential of the strike or the target, right? The higher the probability we can get to that second target could be a lower profit margin, right? Okay, so I'm back here at my screener. And so again, 10,000 different combinations are a lot of combinations for me to try to filter through. So again, one of the things I can do is I can start creating a screener of my own that's going to look at some things that'll help me narrow down the candidates. And so what I've done is I have a saved screener that I created for the webinar. I call it the webinar Bull Call. And we'll look at some of the things that I'm going to add and also some adjustments that I could make to my original screener. All right, so the first one is sector. Why I like putting sector in is I might have, I know for a fact that a certain sector has been outperforming the market, or one sector is driving the market. And certainly if you've been watching the stock market over the summer, you'll notice that, computers, technologies, online retail sales, those ones have really been driving the market. So we might only concentrate on stocks that are inside of that particular sector. If you're interested in how we go about that process, I will refer to you that we do have a webinar we did a few weeks ago about picking candidates based on sector selection, and watch that one, and you'll see a lot of overlay into this webinar as well, how to pick stocks that are outperforming, because basically this is what we're trying to do in our option strategy here today. So I can add sectors, right? And so I can look at all sectors, but here I pick computer technology and consumer discretionals. Now, when I did this earlier in the week, when I planned this out, these ones have been doing really well. But today, market never does what we think it's going to do, right? And today has been a difficult day for both of these sectors. So we don't get a lot of great trading opportunities. We'll look at it in a second. But we might want to pick a different sector, and we'll do that as well for today. But it's kind of the way the market is. Sometimes it works for you and sometimes it doesn't. And today certainly is one of those that it doesn't. All right. Strike differential, we're going to look at that. The strike differential here again will be more of a comparison and not a narrowing of candidates. What I'm going to do is, once I get down to the stock level, the individual stock level, I'm going to do a comparison of, oh, here's a strike differential of $5. It's going to cost me this much, and it's going to give me that much reward. Or I have here's strike differential of $10. It's going to cost me this much, and it's going to give me that reward. And then I might do a chart analysis and say, hey, which one of these has greater potential in terms of strike differential, cost, and profit. So it's more of a comparative analysis. A delta, I'm making an assumption here that most of us have a basic understanding of some of the Greeks, and this one is delta, the change of the price of the option based on the change of the price of the underlying asset. What we're going to do here is twofold. We're going to look at our delta of our first strike, our lower strike, and our delta of the second strike. And we're going to do two things. We're going to first look at the difference between the two. And we want to see a very positive difference. And the sweet spot that I kind of prefer is 25 positive delta. I want to see my first leg be 25% above my second leg. It just seems like those trades work out a lot better. And a lot of those trades, once we get above our break even, will start showing a greater profit faster than waiting for a price to go all the way to our higher strike. The second one, if I can't get that 25 delta, I want to see a 2 times factor. In other words, I want to make sure that my first leg delta is 2 times more than my second leg delta. Again, that will help me find greater profitable opportunities, okay? And so what I've done is I've done a field here where I'm going to look for deltas of 25 or above and for my first leg and 25 or below for my second leg. Strike volatility and historical volatility. So again, I'm going to add those in. I can just type in the word volatility and those selections will be available to me. Again, another comparable analysis where I'm going to look at my implied volatilities versus my historical. And here what we're going to try to achieve is normally what we'll see is that our strike implied volatility and our historical volatility will be about the same, relatively within a couple percentage points. What we want to kind of look for is our strike implied volatility is less than our historical probability, volatility. What we're seeing here in that scenario would be that we're actually getting our options at a discount. We're buying value, right? A lower strike volatility versus our historical. Or if I have a strike volatility that is greater than my historical, that's telling me that I'm paying a little bit more, right? I'm paying more for my trade. And I want to make sure if I'm paying more, I'm getting paid a better return, right? So again, more of a comparative analysis. The next one is our days to expiration. And again, this is the philosophy of trading options, and particularly this strategy. If you understand how options are priced, the premium value, you will know that there's something called Theta Decay. What happens is the premium price, the time value in an option, will start to decay as we get closer to expiration. Now that decay is not linear. It's actually exponential. And it will start to accelerate about 50 days out. And it will go parabolic about 20 days out. So what we're achieving here is we're going to start looking at strategies at 60 days or greater. I kind of like to find ones that are around 90 days. Because what could happen is that we could get a price appreciation and we're not getting that delta theta, that theta decay in our options, and we could actually start capturing a greater profit. And again, this is a philosophy of trading. I know that some of you who are trading shorter term expirations, you're not really worried about that theta decay because the trade is going to come to fruition in a day or two, or if you're playing the earnings. This is for the longer term trader, and really this strategy does perform the longer we hold on to it and the longer we get to expiration. Now you will get that theta decay, but hopefully by the time you get inside of that theta decay, now your strike is in the money. Okay, so I've changed it to 60 to 100, and again, we have had other discussions in our other options seminars, sessions. We're talking about greater liquidity, market participants in our monthlies versus our weeklies. But if you were going to use a shorter term expiration, then I'd probably include the weekly options as well. Moneyness, again, I think there was a question here I saw about moneyness. I want to find my first leg in, my lower strike, probably just close to current price, but above it. But I would be willing to take one that is maybe a little bit in the money, what we call at the money, right around current price, but not deep in the money. I'm not going to do that. I really want to find one that's just a little bit out. So I'm going to be plus or minus 5% at the money and 5 to 25% out of the money. Here's our volumes and our open interests. Again, I think for weekly traders, you probably want to look for a lower volume, but certainly open interest, we probably want to hold a level on that. So if I do that result, looks like we've got 59 candidates. Okay, now we've narrowed this down, right? We really narrowed it down from 1,000 to 59. And again, it's sorted here by the different stocks, right? So 59 different trading candidates, but maybe only about 5 or 6 different stocks. So let's just look at the Apple ones right here. And again, look at that comparative analysis, right? So I'm going to go to my filter view, the filter that I just created. And again, what is my strike differential? Well, let's do, actually, let's stay right here. This is good. What is my strike differential? Actually, let me change this. I apologize. Let me change it to symbol. It's going to give us Apple up top. Apple is not doing very well today, but let's see what we get. Okay, so again, here's our strike differential. Here's our delta net assessments. Here's our applied volatility and a historical. Again, let's start it with volatility. You see that we're relatively the same, right? Okay. What I might look for is an applied volatility where we get a little bit of a discount. So I do see in Intel here, our historical is around 41, but our implieds here are in the low 30s. So this telling us that these particular strike combinations are actually giving us value. They're actually cheaper than what they should normally be. Again, if I find ones that are greater, let's see if I can find one that's greater. Again, here we see on Carnival, CCL, our implied volatilities are in the high 80s and the 90s, where historical is 70. So if I'm going to take this trade, I want to make sure I'm getting a really good profit because I'm paying for it up front, all right? Let's go back to our deltas. Again, I'm looking at Apple here, and, I don't see, oh, here's one that's 20, twofold, right? 20. Here's one that is 21. Here's one that is 25. So this one would be one of the more likable candidates for me because it has that plus 25 delta. I want to look at it. Now that is a $20 differential. That's a lot of price movement. Is that probable, right? Again, we'll look at that probability, okay? All right, so we did the stocks of computers and technology and discretionary, so those ones that are sectors that have been doing well as of late. But I did notice today that there is one sector or one stock in particular that has been beating the tape. In other words, it's been going up today while the stock market has been going down, and that's been GE. And so that's what I've done here is I've gone to GE. And here again, this is where we're doing that comparative analysis where we have a $1 strike differential versus a $3 or $2 or $4 and so on. And what is our deltas here, right? Again, our difference of our deltas. So I do see here, down on this one, here's a $2 differential that is giving me almost a 30 delta. That would be really good. So what is that differential? Well, that looks like it's the $8 strike versus the $10 strike. Okay, so I have to go to my chart and see what that looks like. What's my cost? We'll go back to look at that in a second. Let's look at another one. Let's see what we got here. This is the one I was curious about. This one doesn't give me that positive delta that I want. This is the 9 versus the 10, right? A much smaller differential between our strikes. But when we go to assessing dollar cost and profits, we might change our mind on this one. But there are a couple options here that I like. I'll go back to my main view. Now I'm going to go back to that profit cost analysis. And here was that the $10, right? Where we have a max profit of $1.51, where I have a cost of 49 cents, about 3 to 1 or 300% profits. That's a good trade. That's a really good trade if we can get 3 to 1 or better. But let's look at that $9 and $10 one. And again, this is where, you know, as experienced as a trader, we'll start playing around with things. So here's a $9 strike versus the $10 strike. And let's look at this trade. It's a lot less. It's only $1 differential. But what's my cost? It's only 18 cents. Remember, 18 cents times 100 shares. This is an $18 one option trade. And I could make 82 cents or $82. Now, I know that doesn't seem like a lot, but if we do a multiplier, 10 or more, now we're talking about some serious money. But if somebody who wants to start playing with this kind of a concept of option strategy, here would be a very cheap option for us to get in terms of dollar value. And what's my risk reward here? Now I'm getting close to 450%. So what we want to do now is go to our chart and look at GE to see if we can figure out which of the two would be the better one. And I think this was for a quest to look at candlesticks. And so, yeah, here we have candlesticks. I think I need to look at a little bit more data on this one. Just a little bit more time frame. So the 8 versus the 10, let's draw a couple lines. Let's do the 8. Versus the 10. All right, so yeah, that looks like a nice trade if price can get above $8, and certainly looks like GE is about to get above $8. But what's going on over here, right? There is a little speed bump in our way, right? That we're no guarantee that price is going to get above $8.50. It could get above $8, but it could stall out $8.50. But if I look at the other one, which was 9 versus 10, and I buy that combination, and the price gets above $8.50, right? Now there's a lot of room for GE to run, right? It would be very easy once it gets above $8.50 to go from $8.50 to $10. So it doesn't give me the right delta, but here we're getting a good value, right? I'm getting a nice 4 to 1 return on only $1 price appreciation in this stock, right? So again, when we do this analysis, we'll look at delta. That'll help. We'll look at implied volatility, and we want to look at that dollar cost versus what we see on our charts. We want to find an area where we can believe that our stock will run, right? Remember, this strategy works better on a very consistent or modest price appreciation, because we're going to be holding it for a longer period of time. And do I believe that GE could get to $10 in the next 80 or 90 days, depending on when that strike is? Yeah, I think there's a realm of possibility in this particular setup. Okay, before we tie this all together, I want to just look at some of our questions. Okay. Hopefully I kind of talked about moneyness. Okay. I'm confused. A lot of times I observe that being in a weak financials of any of the XYZ companies, brokers do insist to buy shares of XYZ company. Is it worth it? I'm not going to comment on individual stocks, question is, what would a common trader know about speculation? Again, if you are struggling with the concept of owning stocks or speculating, I think you need a little financial advice on that one. It's concerning a probability is so low opposed to 80% probability. It's concerning that the probability is so low as opposed to 80% up. I'm guessing what you're saying is if I have a high probability event or probability number, is it worth that trade for that profit that I'm going to take? I'm guessing that's what you're asking. And that, again, that's the style of the trader. So why would I trade a trade that has low probability? Again, remember, it's a mathematical formula. It's not saying that that is going to be the outcome. What we're using it is a comparative analysis that says that a lower probability event might give us a greater reward, right? That's what we're doing. Now, the probability is based on a lot of different things. But for instance, if I did a $10 higher level strike, is $10 closer to my current price? Yeah, it is. So it's a lot higher probable event that price will reach $10. Is $12 farther away? Yeah, that's a less likely probable event, right? So the less likely probable event is going to give me a greater reward. That's what I want you to think about. I don't want you to think about it as, is the probability an absolute, right? This is going to happen. What we're just using it is a comparative analysis between 2 or 3 different strategies. How much probability versus the reward, or the risk, or the capital outlay. And in this case, right, are 9 to 10. Where is it? 9 to 10. There it is, 9 to 10, right? It's a 28 probability, right? But here, 8 to 11 has a higher probability. Why? Because $8 is a lot closer to current price, right? So it's more likely for price to get above $8. It's less likely for it to get above $9, okay? If both my lower strike and upper strike options are in the money, should I close the trade out and keep it or keep it until expirations? Well, probably what's going to happen is if both of them are in the money, you're going to get assigned on the higher strike, and then you'll be forced to liquidate your lower strike. Now, what you could do is, if you know on the day you're going to get assigned, your broker will let you know that you're going to get assigned. What you can do is you could buy back that short option, right? You could buy back that short option, and what we call roll up. We could roll up. Now, you might have to buy back at a more expensive price, so you could roll up and sell a higher strike and try to offset the cost that you had to put out to buy back the higher strike, and that will allow you to hold the trade for a longer period of time. But most likely at this point, you're probably going to liquidate the whole trade. Okay, please go over how close before expiration. So again, if I get in within, let's say, 3 to 5 days of expiration, your broker is going to start telling you, hey, just a reminder that you're 3 days from expiration. And they're going to remind you every day. They're going to remind you every day. And so, you get into like that 3-day period and you've captured 85 or 90% of your max probability or profit, you probably want to liquidate that trade. I have a setup in XPD 30 OCK big loss. Yeah, again, I'm not going to talk specifics. Is it better to rely on higher probability options even though they're more expensive? Again, that's the philosophy of a trader. Do you want a greater likelihood in an event to give up less profit? Or, one of the benefits of this type of spread strategy is, low capital commitment to get some great reward. So my philosophy is I'd rather be just a little bit out of the money, just at the money or out of the money, because I'm going to get a greater reward. If I'm doing my leg in the money, I'm going to be lowering my reward. Okay. Credit spreads. Okay, a question about credit spreads. Great lead in before we step away here. So to my friend here, Orlando, make sure you sign up. Actually, we're doing, excuse me, I apologize. We're doing bull put debits next week, but in, what's this, October? In November, we'll start looking at credit spreads. Okay, so Orlando, it's coming. And there is an opportunity to look at those. One of the things I forgot to show you guys before we jump away here is on my links, right? If I go to my links and under my options quotes, if I right click on my options quotes and I go and open a tab, we do have a filter for individual stocks that will be bull calls, bear calls, bull puts, and bear puts. So the bull calls and, excuse me, bear calls and bull puts would be your credit spreads, Orlando. Does that help? I hope that helps. Okay. All right. So what did we learn today? Well, we learned that this strategy allows us to appreciate, take profits, make money in a stock without ownership. We don't have to put up a large capital outlay. Our risk is limited. And we learned about some specific techniques and tools inside of our screener that will help us find some greater trading candidates. Again, I want to point out that stay with some longer term expirations and monthly expiration contracts. Cut your teeth in there, and then as you gain experience, if you want to start to be a little bit more aggressive or you want to play a little bit more speculative, then you could go to shorter terms and weekly expirations. Okay. Always a reminder that one of the benefits of being a premium member is you have access to all these added tools, advanced stock screener tools, premium option screeners tools. So there's a lot of different tools that are available for premium members. If you are interested in becoming a premium member, you can sign up for a 30-day trial period to allow you to test it out, kind of give it a little test drive. And after your 30-day period up, you'll have some different options that you can do. But I will tell you that a 1-year subscription is comparable to about a month of Starbucks visits. So it's very, very reasonable. And certainly for the tools that are available to you, it makes it worthwhile. Before we say goodbye, I will remind you guys that next week we're going to do bear puts, debit spreads. Jean, do you want to add anything, or did I miss any questions?
No, John, you've covered everybody's question that I've passed over to you, so thanks a lot for your good explanation on everything. There's maybe one thing I want to throw out there, because a number of people are saying, how do they sign up for next week's session? Can you go back to that webinars page?
Yeah, sure.
And while we're there, so there's a sign up at the very top of the webinars page, profit from a bearish market using bear put debit spreads. But right above there, do you see the little box with the submit button? If you are interested in being on an email notification list of whenever John comes out with new sessions, you'll be the first to know if you sign up for this email list. I promise you won't get spammed. All you're going to get is notification of when new sessions are added, and you'll be able to be the first ones to reserve your seat that way.
Great, Jean. That's awesome. So with that, folks, I want to wish all you the best of health and the good of all trading.
Thank you. Bye, everybody.